All right, let's go ahead and kick this guy off. So, hello everyone, clients and everyone else who's on the call right now. Welcome to our mid-year outlook. Today is Wednesday the 20th, Wednesday, July 20th, sorry. And we are here just to talk about some of what we've seen in the markets up to this point so far year to date. And looking at some of the future dynamics of what we'll see moving forward in the market and some of our predictions. We welcome everyone through the Zoom link. There's a Q&A option where people can comment. We ask that you interact with us as much as possible. We love to answer as many questions as we can. As an introduction, I am Nicholas Pacelli. I'm an investment analyst and I work with the investment team. On the call, I'll be introducing a couple of the people that will be speaking today. Today we have Tim Courtney, who's going to do an overall market overview. He is our CIO, our Chief Investment Officer. Jon Burkett will be talking on options and some of the option strategies today and what he sees in the market on his side of things. Farina, who is our Senior Portfolio Manager. He runs some of the strategies, including our core equity strategy, our value equity strategy, and a few of the others, teaming with Pete Trontis and co-managing those funds. Jeffrey Hibbeler, who, great guy, runs our fixed income strategies and is our Senior Portfolio Manager. And I already introduced myself. For compliance, we allow everyone the opportunity to read. I'll stay on the slide for about 30 seconds, just some disclosure stuff. And so I'll give you guys a second. All right, and with that, I will hand it first over to Tim, where he'll just talk on his general market outlook. Tim, go right ahead.
Okay, thank you, Nick. All right, so we'll start by looking at kind of where we've been so far this year, and then we'll kind of look at what our base case scenario is for the remainder of the year. If we can go to the next slide. So this year has really kind of been bifurcated into two different parts of the year. We had the part of the year where interest rates were rising in an attempt to manage the inflation, which continued to accelerate. And we saw from the beginning of the year up until June 13th, interest rates, not in a straight line, but they generally moved higher through the year. And in that time frame, as interest rates got all the way up to just about 3.5% on the 10-year Treasury, the assets that were the most sensitive to interest rates, as you might expect, did not experience a good performance through that date. Bonds and high yield bonds were down about 12%. We had growth stocks, which were down about 30%. Value stocks were down less at 12%. Real estate investment trusts down about 22%, and commodities driven by the inflation were really the one standout. They were up 23%. But after the middle part of June, interest rates started to fall and have kind of leveled out. The 10-year Treasury is now sitting around 3%. And since that time, over the last month or so, if we look at the asset classes, since then, bonds have bounced back. They're up 2.2% in that time frame. High yield bonds a little bit less. Growth stocks have outperformed. Value stocks are up 8% versus the value stocks up 2.5%. and REITs, being tied to interest rates are up about 7%. And then commodities, since that interest rate peak, are down about 13%. So that's kind of been the tale of the two halves as the interest rates went up and interest rates have come back down. The market really has been mostly driven, while there's been talk of recession, and we'll talk more about that later, the market has generally been driven by inflation and by the interest rates that are accompanying inflation. If we can go to the next slide, please. So if we look at the current dashboard of some broad market and economic statistics, market volatility, we went through a long time period where market volatility, the Vix was, between maybe 11 and 18. It was relatively low, relatively tame. This year, though, it hasn't been. Market volatility, the Vix is somewhere around 30 right now. It's generally higher than where you would expect it to be during maybe under typical conditions. The 10-year Treasury yield is now at about 3%. It's just now getting back into kind of a typical range from where it was back in 2020, which was, I think it got all the way down to 0.5%. So it's been moving higher. It's been settling around 3 the last couple of weeks. Home prices, as we all know, because interest rates went down to, for all intents and purposes, 0, that encouraged a flood of home buying and the crazy offers that we all saw in the headlines. Home prices are up over 20%. That's well above typical. Although as interest rates have started to come up, a lot of the craziness around the home offers and how quickly the competition was driving those prices. That looks like, just anecdotally, you're seeing a lot of stories that may be ending. We'll see. But certainly we're way off the charts on home prices due to those interest rates being as low as they were over the last couple of years. Inflation, as we all know, it hit a 40-year high. It's at just over 9%. That is obviously well out of the typical range. Inflation, not all of the home prices have made their way into the inflation numbers. That's one of the reasons why inflation is likely to remain elevated, even if inflation does start to come down, as a lot of commodities have started to come down since mid-June. Still, a lot of the home price and rental price increases haven't fully made their way in. So that's likely to stay, if not at this level, still stay elevated for a time. Unemployment is at 3.6%, well below the typical range. It's one of the reasons why, the question about us being in a recession, this would definitely be a strange stat to have in a recession. We could be. We'll talk a little bit more, like I said, more about this later, but unemployment remains relatively strong. The last reading that we had on GDP number was in real terms negative at minus 1.4%. And then consumer sentiment just hit its all-time low reading of 50 to 20. That number is, usually in, say, the 80 to 100%, 100 number. We're at 50. Consumers are saying they're very dissatisfied. They're very concerned and very worried about the inflation, especially the direction of the economy. However, while they're giving these sentiment surveys very low numbers, we had consumer spending actually increase last month, and so again, it's very difficult to be able to tell if we are in recession right now or not. There are certainly some numbers that would suggest we're not, although we may be headed for our second consecutive quarter of GDP contraction. We go to the next slide. The one thing that has been kind of a real dichotomy so far this year has been the market's expectations for growth in earnings. Obviously, the market has fallen. We're down about 15 to 20% in equity prices, whether we're talking about US or international or large or small, the markets are generally down somewhere between 15 and 20%. The market is expecting earnings to fall. But if we look at the estimate numbers for 2022, they've remained relatively high. They're at about a 5 to 10% higher number than where we ended 2021 at. The earnings expectations according to Standard & Poor's is $223 in operating earnings for the S&P for this year. The market seems to be expecting that number to fall, and it very well might. It has fallen. It got up to about $230. It's come down to $223. It may fall further. But while the market has, because we've fallen, and so many market participants are expecting earnings to fall, we have days like yesterday where earnings has come in still relatively good. And so we'll be watching the earnings numbers, which have just been fairly consistently positive through the first quarter, and we're very early into the second quarter earnings numbers, but they've remained positive. So we'll definitely be watching earnings, and whether or not they hit what the analysts have estimated, or whether they start to fall, which is what the market with its correction is predicting. And then if we can go to the next slide. So as we look into the next half of this year, some of the primary factors that are moving the market, definitely the fear and concern of recession will be moving the market, but the market still looks to us to be driven by the inflation issue and what it's doing to interest rates. We saw when interest rates peaked what the assets did. We saw when interest rates have fallen what the assets have done. They've really fallen, the moves of the rates. We think it's likely that because so many of the commodities have started to fall, and because there will start to be pressure on consumer spending as inflation just continues to remain high, that inflation is likely to peak and start to fall. Although, like we said before, because so much of that CPI number is dependent on rent and mortgage payments, and some of those have not made their ways in, we expect inflation to remain elevated, even though it does likely will start to fall here in 2022. A lot of the speculation and leverage in markets has been taken out as interest rates have gone up. That's discouraged the use of leverage, and a lot of the most speculative areas of the market have seen the worst returns. We think that speculation and leverage in markets will continue to abate throughout the rest of this year, and we think that's a healthy thing for markets to establish a better foundation that we can start when we move out of this current bear market. For GDP and earnings, we're not sure when this recession will occur. We know we're likely to experience a recession in the coming quarters. And so for the rest of the year, we feel like GDP and earnings will be somewhere between slightly positive and slightly negative from where we saw the prior year. Again, GDP last year had about a 6 to 7% growth rate. We knew that going into this year, we would not hit that high level in GDP growth. So for the full year, we would expect that to maybe be slightly positive or slightly negative from what we saw last year. And for earnings, I think we hit about $208 of operating earnings on the S&P. We would expect that to maybe be slightly positive or slightly negative when we look at the full year for 2022. And for volatility, like I said, we got used to kind of some really nice, very tame volatility for a number of years there leading up to 2020. It's likely that volatility will, we feel like, remain elevated for the rest of the year as the market is incorporating in so many bits of information, such as the war, supply chains. We have an election coming up that's likely to keep that volatility elevated. Although I will say we went a stretch there where markets were moving up and down 3, 4, 5% a day. It has been, I think, a slightly positive development to see volatility not have those wild swings from day to day over the last couple of weeks. Things have calmed down a little bit in terms of the size of the moves we're seeing. So that wraps up my part of the presentation, and I'll hand it over to Jeff Hibbeler, who will talk about fixed income.
Yeah, thanks, Tim. Appreciate it. So in fixed income markets, this year so far, it's really all been about the Fed, the Federal Reserve, and inflation. And really more specifically, it's been the Fed's policy changes to fight inflation. So looking at the first half, and actually going back a little bit to the end of last year, the Fed pivoted policy. And at that point, they began reducing their bond purchases. In this year, their first hike was in March, 25 basis points. And they've been increasingly aggressive in their hikes with a 75 basis point hike at their last meeting in June. That took the upper rate in their funds range to 1.75%, where it is currently. Prior to their actual hikes and throughout this cycle, the bond market's been adjusting to and pricing in a faster pace of hikes. And a lot of that's in reaction to the Fed's comments and speeches that they make that have been becoming increasingly hawkish as inflation has continued to rise, as Tim pointed out, and is now at 40-year highs. Nick, if you want to turn to the first chart, please. So this chart shows the year-to-date change in Treasury yields through last Friday in the yield curve. The green line is last Friday. The blue line is where we ended 2021, and it shows the magnitude of the rate changes, particularly in the shorter end. That coming into the year, they were near zero before the Fed began actually hiking rates, but the yield curve has again shifted upward quite significantly across all maturities. And with the move in the front end, that's led to a flattening of the yield curve. And in some maturities, we've seen an inversion that's been in the press a lot. And one curve comparison that the markets tend to focus on and gets a lot of press is the 2-year and 10-year maturity. That's been here recently dropped to about a negative 20 basis point inversion, and has again gotten a lot of attention, as that is one indicator that tends to show that recessions could be forthcoming. In corporate bond spreads, which are the additional yield that is earned over treasuries to compensate for credit risk, we've also seen those increase year to date. In investment grade corporates, where we're focused, those spreads are a little above what I would consider to be kind of average-ish levels, and roughly around 1.5% yield in addition to that of treasury securities. So looking out for the remainder of the year, I think it's likely going to continue to be all about the Fed and inflation. However, though, as Tim pointed out, the market and investors are also watching more closely for recessionary signs from the economy. With the Fed, it's getting its funds rate to a neutral level expeditiously, using their terminology. And we have another Fed meeting next week where they're expecting to hike by another 75 basis points, and will essentially bring, at that point, the funds rate to roughly a neutral level. But with inflation running where it is, very high rates, both in overall inflation and core inflation, and probably as importantly, the monthly increases haven't really slowed yet. They clearly have more work to do. And the Fed projects they're going to take the funds rate to around 3.5% by year end. The markets are currently pricing close to that as well. Behind that assumption and projection, there's the expectation that inflation will be subsiding. And as Tim pointed out, that does seem likely, but the risks are that inflation is stickier than expected, The lagged housing influence on CPI is a great example of that. And they may have to sustain higher rates and hikes longer than anticipated. Additionally, policy tightening from the Fed will, here at the end of, coming up soon through the end of the year, will begin to impact the economy more fully. That should start to slow growth. And also help to ease inflation pressures. That, of course, will increase the chances of recession, and some of that's dependent on how quickly inflation falls. And that pull between inflation and recession has been driving a lot of the volatility in the bond market, and that will also likely keep the yield curve inverted and quite possibly push the inversion further. So we think that until there's clear evidence that inflation is moving sustainably lower, the Fed's going to remain hawkish with their policy and continue to tighten it. So, okay, we've got the second chart up. That's great. And there's some good news in that market expectations of inflation have been subsiding. The green line is the 2-year market expectations for inflation over the coming 2 years. The blue line is over a 10-year period, and that's based on expectations from U.S. TIPS bonds. So, you can see that especially 2-year has been much more volatile. We saw a big run up early this year as, part of that was war in Ukraine, oil and commodities rose dramatically, and then has been coming down quite a bit, particularly as the Fed has been tightening policy and projecting a much faster path of rate hikes. And looking at where we are now, 2-year expectations still around 3%. I think the Fed's going to still want to see that come down further. Clearly, these moves are a good step in the right direction. But one of the keys is to see actual realized inflation begin to slow. So, with regard to yields, clearly the move in yields are the largest in the first half that we've seen in decades. But likely the bulk, that's going to be the bulk in the move in yields this year, as a lot of, again, the Fed increases have been priced into the market. Certainly how inflation evolves will be a big influence on yields, particularly in shorter maturities, as that's going to drive Fed policy. And longer term yields tend to be more influenced by economic growth and the path of it, and also the global yield environment, with lower yields overseas have certainly weighed on ours for many years. So as a result, we think the yield curve will likely stay inverted, or at least at very flat yields in the coming months. We do think there could be some upside in short-term yields, particularly if the Fed restricts and needs to restrict monetary policy further, while the longer yields are going to be more sensitive to changes in economic growth. So in our internally managed strategies, we've been continuing to position them defensively, running shorter durations than we historically have. We're also seeing good opportunities in investment grade corporates, with those spreads and yields increasing, and seeing that corporate fundamentals and also their debt maturity profiles are supportive of investment in that sector. Finally, with regard to fixed income overall, we view it as the anchor of a diversified portfolio that provides stability to it and income generation. With that, I'll turn it over to Randy.
Thanks, Jeff. Reminds me of our monthly call, turning it over to me, and I get to listen to fixed income. Never get enough of fixed income. Glad that led equities. Now we'll go into equities. Just introduce myself, senior portfolio manager here at Exencial. I run all the equity strategies along with my co-manager, Pete Trontis. Before joining Exencial, I spent 20 years at Putnam Investments as a portfolio manager. I want to spend a few minutes just on the team. I think our key differentiator is the equity team we have. We have 6 people on the team, 3 CFA charter holders. We have a good mix of experience and new analysts. Rich Irwin's been with investing for 50 years, been with the firm over a decade. To be able to draw on his 50 plus years, or almost 50 years. I know April of next year would be his 50th year. Just to be able to draw on that experience is invaluable. And then we have Ben Courtney, who joined 5 weeks ago. So, 50 years, 5 weeks, similar levels of experience. Ben has been with the firm for a number of years interning. Happy to have him along now as an analyst on the equity team. We also have, as you all know, David Yep has been with Exencial for 8+ years. Really solid in healthcare and new technologies, and again, fabulous resource to have on the team. We also have Nick Pacelli, doubling as the moderator today. He's been with us 2 years. I've mentored him over the last couple of years, but I noticed in the introduction, he said, Jeff's a great guy. I literally got 0 as an introduction, but that's okay. And then finally, Pete Trontis, again, co-manager with myself, been at the firm for 5+ years, managing all the strategies, has been investing for 10+ years. Again, I think the team has good collaboration, and it's again, our key differentiator at Exencial, I feel, is the team we've put together. Let's move on now to, the outlook for the second half of this year and beyond. This is a slide I actually used last year. Here's what we thought a year ago. Global growth was on track. Asset prices were rich to fairly valued. And if you look now over 1 year, the market's down about 8%. The S&P is down about 8% from a year ago today. I'm not sure when we did the webinar last year, July or August, but we're down about 8 to 10%, let's call it. So, what we thought was rich to fair value, has come true. The markets are down. Fed policy a year ago was accommodative. They were still keeping interest rates at 0, and there was that whole, we're not thinking about whatever they were thinking about. Clearly, a policy error. That was a lot of what Jeff and I talked about, and everyone on the Exencial team, but a lot on those monthly calls was the Fed making a policy error. I think in hindsight, we can say, yeah, they did. Where we go from here, that's how you calibrate, future returns. Again, year ago, balance sheets were rock solid, cash flow was great, and the question was the new normal. Next slide, Nick. Where are we today on the economic backdrop? Jeff and Tim both gave a good summary of where all the key indicators are: unemployment, other signals from the Fed, from the fixed income market. But global growth, no longer on track. It's slowing. A recession is highly likely. I think we all know that. Whether we're technically in a recession or not, I don't know. And Jon Burkett has a good line that the whoever makes the recession call, the NBER, I don't even know if that's the correct board that determines when the recession is, they won't let us know for a year after it's passed anyway. So again, that technical term recession, we won't know for a while, but we know the economy's slowing down. Companies are talking about seeing a slowdown potentially in the second half, or preparing for a slowdown. I'll touch more on that in a minute. Asset prices have corrected. Markets are down 20%. Year to date, 10% over 1 year. I think they're getting cheaper. There are certainly pockets of valuation opportunities now that we're exploiting and think will be areas that you want to hold for the long term. Fed policy no longer accommodative. I think a key question could be when they pivot. We're going to get the 75, maybe 100 in July in another week, next week. And then when we get into the fall, if we see the economic backdrop deteriorating, maybe they pivot. So I think the signal could be changing from them. That's just my opinion. Something to keep an eye on. Back to corporations and health. Banks are buffering for provisions now, raising their provisions just to buffer and buybacks. Some of the post-09 regulations are going to restrict some of the buybacks now as they have to buffer capital. again, companies have been through COVID, the once in a 100-year, health crisis that really grind or business went, shut down effectively and then opened up. And some parts of the economy were better than others, snapped back faster than others. I think they have really navigated through some rough waters. And I think, a shallow slowdown in the economy, a lot of the experienced management teams are from back in 08, 09, they know how to manage. So I'm fairly comfortable with that. Corporations and the management teams are able up to the task in navigating through this. Key question again was the same question last year, I guess. What's normal? We will get through this tightening cycle. As I said, a pivot could come at some point. The slowdown will happen, is happening. Post that, what does it look like? Remember, there's always a recovery after a slowdown. As how do we prepare for that? How do we position for that and whatnot? How do we think about it? But what we really need to think about, what is the longer term growth rate? Maybe Nick, move to the next slide, just the economic outlook. As I said, markets are becoming cheap. What does cheap mean? It doesn't mean pile in, you're going to get 10% Q1, Q3 and second half. The market's skew now, in my opinion, is more favorable than it was at the start of the year. You've had the compression in a lot of sectors. The valuation excess, has, as Tim mentioned, come down quite significantly. Bitcoin off 50+%. The COVID beneficiaries like Peloton, Carvana, they're off 75+%. Some down 95%. I invested through the .com. I had joined Putnam in '99 as an tech analyst, so I lived the .com bubble. That compression of valuation, or the drawdown in the equity market, happened over the course of 3 years. Now, NASDAQ fell 75% from peak to trough. Quality of companies now versus then, cash flow generation, both, there's a significant difference of the quality of companies today. They're much higher, much better companies, much better managed, less cyclical, that are in the top of the NASDAQ for sure. But that drawdown took 3+ years. S&P was negative in 2000, 2001, 2002, and was down significantly in 2003 in March, before the war in Iraq started. And then the markets kind of, cleared itself. The recession that was shallow from 02 cleared, and we moved up from there. But this has come like that very quickly. You've had a valuation compression, just as you had the straight up in 2020, a lot of those stocks. So markets are healthy, inefficient in short periods of time for sure. But over the longer term, I do think asset prices and cash flows do align. So that's good to see. As Tim said, healthy for a long-term market to see that. I think there's pockets of expensiveness today in defensive stocks, staples, utilities, energy. Again, over the last 1 year, S&P down 8, consumer stocks down 15+. Again, bearing the brunt of heading into a slowdown. Yeah, they're down. So, but that's probably some opportunity getting created with that drawdown. Staples are up 5%. Commodities are up significantly. In fact, I saw a statistic in a semi-annual review that I was looking through. The commodity index is up over the last 5 years now more than the S&P at 12%, and the S&P is up around 11 or so. So again, commodities have inflated or have had a significant run that they've beaten equities over the last 5 years now, and specifically over the one last year. So what are some of the trends we see? How do we use trends to help allocate or pick stocks? Some of the trends, we like semiconductors. Think that the growth rate of that industry will continue as we digitize everything we do. You can look at your temperature, your refrigerator from your phone, and just, your car is becoming more, the cockpit is electrifying significantly as we move towards EV. That consumes more content of silicon. It's just a great industry, cyclical, but a growth industry that we want to have exposure to and use volatility as a way to add exposure to it. Automation, another, last summer, significant struggle for service businesses to get staff. Not hearing that today, but also some manufacturing and other jobs. I think automation is needed to help bolster some of the lack of skilled workers for some of those areas. Onshoring a U.S. manufacturing would be great. I think the U.S. is about to finalize or has finalized the package of the CHIPS bill that'll help bring some semiconductor manufacturing back to the U.S. And I think that's a good thing to have more stable for the supply chain, for national security, and for a number of reasons to have manufacturing based in the U.S. And I said that a year ago about most of those things, so that my view on that hasn't changed. Last point is just to be patient. There's a lot of noise in the market, whether it's economic indicators that come out weekly, monthly, Fed action, Fed inaction, Fed, one guy speaking weekly or multiple speakers weekly can move the markets. We still have the war in Iraq. We still have the war in Ukraine. Putin today said, yeah, I'll turn on Nord Stream gas into Germany tomorrow at 20% is what I read recently. So he's still a wild card. The situation in Europe is still a wild card. The energy situation in Europe is much more drastic and a concern for companies, for industrial manufacturing, for sure. It's something we need to keep a critical eye on as investors as we're running the client portfolios. And midterm elections, I don't think that noise has started yet, but that's coming as well. So again, the key message is patience, because there is a lot of I don't want to call it a circus-like atmosphere. The markets just tend to react to news and uncertainty, and you just got to be patient and not make knee-jerk reactions to news. Try to be more proactive. Try to be more thoughtful. Summarizes, no more slides here, but had plenty of client interactions in the past couple of months. I get the anxiety clients are feeling. I have family members come in and they're telling me their portfolio is down 20%, and I can see the anxiety. And I'm 95% in equities. Sorry, Jeff, no fixed income in my individual. But I'm down 20%, and whether it's a couple of zeros or a lot of zeros, that impact is real. But what we want to try to is look beyond just the short term. Have some perspective. Look at your portfolio balances from 2018, 2019, 2020. It's just not always from the peak. There is a perspective that we have to have. And remember, we're trying to accomplish long-term goals. If I'm saving for retirement, I'm 50, I'm not going to retire for another 20 years. I'm going to beat rich. I'm going to have 60 years in the investment business. So if my retirement is 20 years from now, should I be that concerned about the recent bout of volatility and down 8% over 1 year? No, I should. If I need cash flow in the next 12 to 24 months, then that's a different allocation I'd have in my overall portfolio. And that's why we stress it's critical you work with your advisor, and that partnership, that relationship is critical for your peace of mind, but also for your long-term goals to be achieved. So again, that is where you should be discussing how you feel about the markets, your risk appetite, and your long-term goals. Again, not to minimize that the market's down. Again, we all feel that when they're up and to the right in green, everybody's happier. So how are the portfolios positioned? Just high level, what is our philosophy on the equity team? How does the team think about buying stocks, allocating stocks to portfolios? Intrinsic value is our underlying compass, our anchor, I call it. And what is intrinsic value? It's really the measure of what an asset is worth, not so much what the current price is. I think today's prices potentially are dislocated from asset value. The price is blinking red, and not today, but prices are down because there's uncertainty on the near term. I really don't think that takes away from companies' longer term growth objectives, growth possibilities, cash flow generation, and underlying asset value. but the market moves non-linear. Stock prices and cash flow growth in the future don't always align perfectly. They did in 2020 when a lot of those names like Peloton got overvalued significantly. Can say that in hindsight, obviously, but even then, didn't think that the cash flows that they could potentially generate down the road came anywhere near to what the market was pricing it at. But that's our underlying approach and philosophy on the equity team here. We obsess over what is the growth rate longer term, what are the margins, what is the moat this business have, what is the peer margin structure, or what are the longer term capital intensity needs of a business? How are they doing with working capital during this COVID period? Do they have to draw on it? Do they have to build inventory? All those things go into a long run intrinsic value, and that's what we look at. That's our underlying philosophy. How we're positioned today, I think we have a good balance. We have 10% plus cash in most of the portfolios, if not all of the portfolios we run. And that's a buffer for this uncertainty, but also to use it opportunistically. If a stock that we like, that we have an intrinsic value model on, suddenly has a Netflix moment last quarter or a Facebook moment last quarter when it drops 20, 30%, and we feel that the risk reward is now skewed favorably, we'll buy it. So I really think this cash that we built is a dry powder. I think we are not overweight the what we would consider the defensive sectors in most portfolios, because again, the value has been realized there. And I think it's time now to take a closer look, sharpen the pen and pencil at the sectors that have been hit the most, tech and consumer. Again, what we look at, quality, really well-run S&P 500 mostly type companies. Not we will occasionally look at some of the upstart companies, but that's not where we're doing most of our fishing. So again, balanced cash, 10+%. Opportunistically, we'll be deploying that as we go through this quarter earnings season here, and as we get some more clarity on the Fed cycle. But just wanted to give you a little flavor of team, process, and positioning in our outlooks. I'll leave it there. I'm going to turn it over to Jon now to discuss options.
Thanks, Randy. My name is Jon Burkett. I manage the firm's option-based strategies. So that includes covered call, custom options for concentrated positions, hedged equity, and the various put writing strategies that we offer. If I could have the slide that shows market volatility, please, Kevin. I think it's the next one. There we go. So what you'll see on this chart here is the Vix Index. It's kind of a shorthand way of viewing market volatility. And the median level, it sort of hangs out in a range between call it 10 and 15 during most market conditions. And then occasionally you'll have a jump up into the 20-30 range when there's a spike in fear or uncertainty. And then occasionally we'll have crises where it can get up into the 40, 50, 60, 80 range. And you can see that there clearly during the COVID crash. The equity volatility exploded higher. And then since then it's been compressing. Now, on the other hand, on the fixed income side of the house, US Treasury volatility has been climbing steadily. Obviously, interest rates got very close to zero, and inflation has been elevated. So that's not a great combination. So really, the epicenter of the pain in 2022 has actually been the fixed income side. The jump in equity volatility has been more measured. So we're still in that 20 to 30 range where it's elevated, but not in a complete panic or crash state. And we do expect, given all of the various macro cross currents that are going on, between geopolitics to a central bank that has, potentially blown a call and is now pivoting and getting quite aggressive in their fight against inflation, we do expect volatility to remain elevated for at least a few more quarters. I don't think we're quite out of the woods yet. It's impossible to say whether we're in a recession or we'll hit one for certain. I would say that many of the leading indicators are still heading the wrong way, so risk is high in the near term. But as Randy said, it's important to maintain perspective. So the S&P 500 is up 75% over the last 5 years, nearly 12% a year. From the COVID lows, we're still up 83%. If you measure from the exact highs of December 2021, the market's down 16% this year, and that's painful. But if you measure from a more reasonable standpoint, such as the 200-day moving average, rather than cherry picking the exact high, we're only down closer to 10%. So this is so far what I would characterize as normal or garden variety market volatility. It's painful not to downplay that, but this really has been a very sort of humdrum episode of volatility so far. And these periods of occasional fear are the price of entry to the long-term wealth building potential of investing in equities. If you cannot stand the pain of these sell-offs, then it's very difficult to build your long-term wealth. If I could please have the chart reflecting the business cycle. Here we go. So this chart shows the Manufacturing Purchasing Manager Index. So it's a survey-based metric that's commonly used to sort of show the business cycle. We had the slowdown in 2020 and the COVID crash, and then we had the rapid recovery thanks to extraordinary stimulus measures. And now we're cooling back to more normal measures. And the risk is that we dip back into a second recession. Again, it's uncertain whether that will happen, but the risk is there. If we could jump to the slide showing financial conditions, please. So financial conditions are tightening. On this chart, higher is tighter and lower is more loose financial conditions. Central banks have been already tightening outside of the US for several quarters. So the Fed is arguably a little bit late in starting to hike and implement quantitative tightening, but they are moving very aggressively. So, chances are high of another 75 basis point hike next week, maybe even 100 basis points. And I would expect the Fed to continue, they've made it very clear that their priority is controlling inflation, which it should be. And they believe that the economy remains strong enough to handle it. So it is very likely that the Fed are going to do exactly what they say and keep tightening until either inflation is not only downticking, but really showing signs of being definitely controlled, or unemployment starts to mount. And at that point, they may start to consider a pivot. But we have not yet reached that point. So additional tightening is probably in the cards. And it does take time for that to flow through the economy. So again, we're expecting several more quarters of elevated volatility. And the last slide, please, with the misery index and the growth tax. There we go. So the blue line here is the what I'm calling the growth tax. So it's the price of oil, the interest rates, and the U.S. dollar. So essentially, costs for corporations. And then the red line is the misery index, which impacts consumers, and that is unemployment plus inflation. And you can see that both have risen steadily this year, and that is exactly why both consumer and CEO sentiment surveys are at record lows, because those costs are mounting. And this will have an impact on investment and consumption, but of course it operates with a lag. So again, several more quarters of volatility, I believe, is in the cards. Now, that doesn't mean that the market goes straight down. Volatility just means bigger swings in both directions. Returns do tend to be more muted during periods of heightened volatility. But again, we've had very strong trailing returns. So a period of more average returns is not to be feared. And with that, I will hand it back to you, Nick.
Perfect. Thank you very much, John. So now we have reached our Q&A session. We ran a little bit. We got 9 minutes left for questions, but just to reiterate, we'd love for anyone, all clients, please send in your questions. If we don't get them back within the next 9 minutes, we'll make sure that we reach out to the advisor that you're working with and make sure you get your question answered. So again, please reach out. But one of the first questions that we have is regarding the Fed and raising rates. And the question is, I read the Fed is planning to raise the rates 100 bips versus a 75 bip increase. What is to be expected if that happens? Randy, I assume that would either be on your end or Jeff's end. I guess you can talk about it from either perspective.
Yeah, I can take it, Nick. So yeah, at the next meeting, kind of coming into it, the Fed had signaled 50 to 75 with CPI and other, economic data. Clearly 75 is kind of where they're at. With CPI coming in quite a bit hotter last week, 100 basis points was bantered about. The market is pricing a small possibility of 100 basis point move. But I would say, several Fed committee members have spoken since then, and a couple of them really the most hawkish on the committee, and are indicating that they would be leaning toward a 75 basis point move. I think there's also a little bit from a Fed signaling standpoint. Each hike so far this year has increased by 25 basis points. If they went to 100 this next time, and depending how the data evolves, does the market start saying, hey, at the next one, do they go 125? I think 50, 75 basis points are quite large moves, particularly what we've seen over the last, 25 years in tightening cycles. And they also want to see the effects of their tightening start to work through the economy. As we mentioned, that's just starting to hit. So I think, 75 is it's not a done deal next week, I would say, but it's by far the most likely outcome.
Anything to add from that, Randy, or are you good?
Who could add to that? I think that's
Okay, perfect. Well, so this could be another one for you, Jeff. It's us asking about inflation rates. So it's asking that if we're going to see an inflation rate maybe higher than the 2 to 3% target moving forward with energy prices and home prices. Do you see that being the new inflation rate being a little bit higher than the 3% level moving forward over the next few years? Or what's your, new normal rate based on inflation?
That's a good question. Do think it's likely, inflation isn't going to inflect straight back down. I think, like I mentioned earlier, the risk case is that it stays stickier longer, and with the housing in the pipeline, that will take some time. I do think 2% inflation has been the target. That's where the committee wants to get back to. And at this point, they have a dual mandate. It's stable prices and full employment or maximum employment. They've met the maximum employment mandate. They're clearly missing on the inflation side. So, at this point, the choice is very easy for the Fed to fight inflation. Looking down the road, let's say in your circumstance, inflation comes down to maybe 3% area, but unemployment has trended up. Then there's a choice to make. I do think there's a lot of research, and I think they feel very strongly that price stability closer to that 2% area is the place to be. And I think it's just the question is, how long does it take to get it down there, and how much economic pain could potentially occur to get it down there? I think given what we know now, they're going to work really hard to get it down closer to that 2% area. And easing of commodities, we've seen some of that here in the last month. Clearly, we need more on that side, but that will help to bring things down. So I do think it will take time, but I think eventually, they're going to want to get it below like a 3 to 4% type of level. They're going to want it closer to a 2.
Thank you, Jeff. So I guess this is a general market question. So Tim, you could answer this, or John, if you want to jump in here. But regarding this economic cycle, is there any insights we can gain from historical economic cycles into this one? And does that affect maybe any of your expectations moving forward?
Yeah, I'll answer, and then maybe John, if you want to follow up. It does seem like everything in this cycle has been so compressed. We had a huge, quick market downturn. We went to the fastest bear market ever in March of 2020, followed by huge amounts of stimulus, both fiscal and monetary. The chart that John showed, we zoomed higher. We had 6% GDP growth in 2021. We had record-breaking profit margins, record-breaking earnings numbers in 2021, and to follow that back up, you wouldn't expect to see those kind of numbers continue at that pace, and now we're starting to see those numbers tail off probably faster than maybe you'd expect. And so this has been an abnormal cycle. It was juiced at the beginning. They're now trying to take back a lot of that stimulus and both monetary and fiscal that was set up in 2020. And so it may be that we're in a very compressed market. The market from bottom to peak went about 120% from March of 2020 to the end of last year. And as we noted, we've had about a 15 to 20% pullback. We've had 2 20% pullbacks in the last 2 years. That's more than what you'd expect. You'd expect maybe a 20% pullback maybe once every 4, 5, 6 years. We've had 2 in 2 years. So I think it just goes to the fact that we've had a unique set of circumstances compressing everything down into a very, a very tight window. And, and we're talking about, when the next recession will hit. So it's, and that's also why some of these numbers don't make sense. You see, you see people asking, are we already in recession? And you're seeing 3% unemployment, and you're seeing consumer spending continue to go up. It's very odd, but I think it's a result of just the unprecedented circumstances we've been in. So John, any other points on that?
Yeah, I agree completely. It seems likely that we'll have a compressed or shorter cycle. We really should have had a recession in 2020, but we largely avoided it thanks to the, essentially unprecedented degree of stimulus. And, when you sort of artificially juice returns in the near term, that tends not to be sustainable because you're not really impacting the long-term sustainable growth rate. So, the question is whether more government interference in markets is the solution or not. I mean, that's a debate for a different forum likely, but yeah, we've really seen governments and central banks do a lot in a very short time period. And that did flow through to investor psychology. There was 2020 was, almost a rush to buy any kind of risk asset, including, some quite low quality speculative types of assets really blew up in price. And now we're seeing that that excess wrung out of the system as central banks tighten again. We obviously have spent a lot of time internally debating, what are the metrics that we should be watching, and it's important to differentiate between the sectors or indicators that tend to lead the economy and those that are more lagging in nature. And unemployment is a lagging indicator. Actually, if you wait for the high point in unemployment is often well past the bottom of the equity market, and inflation tends to lag as well. And the other complicating factor is that inflation has a psychological component. So we saw, again, we've talked about this internally, but the bullwhip effect, where purchasing managers saw the time to get their orders fulfilled extend due to supply chain disruptions. So they over-ordered in response so that they would have more available stock on hand. And many people saw that as a sudden surge in the sort of the long-term growth rate of the economy, when in fact it was a temporary factor. So we are giving back many of these artificial impacts from 2020.
Thank you, John. So we are already 2 minutes over. I'm wondering if we can stuff in one more question for the loyal people who actually hung around this long. Let's see if we can get that one in. All right, I'm gonna go ahead. We'll see if we can get one more here. So with all the headlines recently, with the dollar being roughly in line with the euro and the strength of the dollar year to date, what does that mean for the economy, and how has it been affecting some of the portfolios? If we could just have somebody jump in on that.
Yeah, now's the time to travel to Europe if you want. If you're a U.S. citizen, take advantage of the euro, parity. It's impacting companies. FX, you saw Netflix report last night. FX impact a couple of $100 million. Microsoft, pre-announced a few quarters ago, a month ago, a few weeks ago, about the impact that they'll see in this quarter. U.S. companies translating European, Asian revenues back are going to take a hit. Conversely, you're seeing European companies have a company that we're following, Assa Abloy, reported 25% revenue growth, but 13% of it was from currency, translating the US over to the euro. So it has over the long run, I think it has a washing effect. The ups and downs and the pricing and the competitiveness of the markets, adjust to any regime change in currency. But in a short period of time, it can be impactful. I think you layering that euro parity with the gas situation in Europe, going to be tough for Europeans to want to travel outside of Europe. So you can think of it from that perspective. If we're owning some travel stocks that need European travelers, maybe there's a headwind there. So again, it's not, John likes to use the term garden variety to describe this market correction, and he's right. The currency movements, they are, they're not uncommon. We are at parity now. I think when the euro first came out, it was at 119 to the dollar, and now it's at parity. But it went all the way down to 85 back in 2003. So you do have these swings. I think the companies and the markets react and self-correct, but in any short period of time, it can be a significant effect. So long run, we're not actively trading on the currency moves, to be honest.
About wraps up. We're about 5 minutes over. For all of the questions that we didn't get answered in our Q&A session, we'll make sure we get those back to you. We will save them and reach out. Thank you very much for everybody's time. Really appreciate you spending with us for the last little bit, about an hour, a little bit over an hour now. But thanks again. Hope everybody is having a great summer, and have a great day. Thank you. Bye.
Thanks, everyone.
Thanks, everyone.